All right, so let's start. I put this file out there for y'all where I was doing the H model, and it bothered me that I had a few of them out of order, and so I forgot to record this in the last class. So I did the recording and I figured out how to fix that. So if you have some of them out of order, what you can try to do, this is column S. You can just sort it one more time, and then sort it by column S. And that fixed it. So I should have just sorted my more column. Now that's possible. You're gonna have one that's always out. I haven't sat down and tried to figure out the math, the interaction between the growth and the discount rate, but that looks a lot better. So I did get it fixed. So maybe I need to load this again. But if you watch the video, I do it, the first part of the class video, I actually fix it in there. All right, so tonight we're going to talk relative value. Poor Dante, you've seen this twice, but you'll see it one more time. You want to teach it? You know it well enough to, you probably could. Well, in the investment class, but you saw it in the business. But we're going to go in a little more detail here because of what you got to do with your target PE. And then I'm going to, on Thursday, we're going to get into detail on the model. Hopefully more people, we'll probably schedule all the times on Thursday because there's not many people here tonight. So we'll get that figured out. Remember, if you build a model, even including coming to the class, you build a model, you get a 10% bonus. So that's kind of nice. So you definitely want to do that. So I took a lot of this from Dr. Demorteran. He has an entire video on relative value. His frustration was it's not taught in college, undergraduate or graduate, but everybody's using it. So he finally threw in the towel and says, I got to teach this. So his idea was everybody's doing it. That's fine. But let's do it, at least do it correctly. If we're going to do relative value analysis, let's do it correctly. And you saw that model I gave y'all last class really is a relative value model. It's not a discounted cash flow model. So we have to get this correct. And then we're going to take this to build your model for paper 7. So between the Excel file I showed you last class and what we're going to do in this model, you're essentially going to have almost 100%. You'll have everything for paper 7 except for the final summary of all the different models, the football charts. So you have everything. So we're almost doing the entire paper in class, which is great because some of y'all really need to get caught up, and it's getting a lot easier now. So if you can go back and get caught up, the last few papers are not that bad. So relative value analysis, let's just understand how it fits in with the other approaches. I'm going to give you a real estate example because that's how we just normally think relative value. And then how to do it correctly, we'll have to figure out for your industries. It's going to be pretty obvious for most of your industries which price relative to use, and then how we'll put it all together. And then next class, we'll get into detail on exactly how to build the model, and then we'll actually build the model next week. All right, so there's 3 approaches to valuing stocks: fundamental analysis, technical analysis, relative value analysis. Papers 5 and 6, really papers 2, 3, 4, 5, and 6, that's fundamental analysis. You're assessing the firm and you value it. So papers 5 and 6, fundamental analysis. You're forecasting the firm, you're valuing their cash flows, that's fundamental analysis. Paper 8, you're going to do technical analysis. I've made it real simple. I just want you to be exposed to the idea of technical analysis. And you just have to pick 3 to talk about. It's usually the shortest paper other than the exec summary. So it's usually the one almost everybody gets a decent grade because it's pretty easy to do. So then paper 7, relative value analysis. That's where we here are. You can use all 3 of these at the strategy level, deciding whether you want stocks or bonds or large cap or small cap. And you can do all 3 of them at the security level. Do you want Apple or do you want Microsoft? So it works at both levels. I've used them for both levels. I've valued stock markets. I've valued stocks. I've used technical analysis. At UTSA technical analysis, we use, I'll talk about Ned Davis. We use them, and I became a believer at the asset level. Technical analysis, there was a firm, the firm we use, they had their 9 factors for calling the bottom of a market. And in February of 2009, 8 of the 9 were all saying buy. They timed it just perfectly, and I was like, wow, this is really good stuff. Telling you when if a model can tell you when to buy, that's pretty good. So that's what you're going to do in paper 8, is see if the market is telling you from a technical analysis whether it's a good time to buy or not. So let's talk about relative value analysis. So with relative value analysis, you're going to take some value of the asset. So we're going to see the only values we're going to use are price and enterprise value. Those are the only two we have, and that's the only two you normally use. So price and relative value. And then we're going to compare that to some fundamental value. So your company might pick price, your company might pick enterprise value, that's depending on the industry, and then your fundamental factor is going to change depending on your industry as well. So price, enterprise value. What is price? Price is price. It's the market value of the firm. Enterprise value usually is defined as market value plus debt minus cash. So it's stockholders, enterprise. Make sure in your notes it's real clear. Enterprise value is both stockholders and bondholders. Price is only stockholders. Now, is it possible for enterprise value to be less than price? Price is per share, but you can do market value, which is the entire value. Because most people take enterprise value, they take market value plus debt minus cash because they're subtracting cash. It's possible for enterprise value to be lower than market value because a firm like Microsoft might only have $10 billion in debt, but they may have $20 billion in cash. So it is possible. Generally, though, enterprise value will be higher than market value. All right, on the fundamental factors, next week we're going to spend quite a bit of time on this. We'll probably bring in 3 factors, and then we'll let the model decide which of those 3 is the best. But the 3 we're going to use, one will be earnings based, one will be revenue based, and one will be book value based. Those are usually the types. Earnings based, we have a couple of choices whether we do it before or after interest and taxes and depreciation. So there's some choices there. Your industry will have a relative that's more specific to your industry. We'll talk about that. Banks almost always, in fact, really always, it's price to book. Retail is almost always, in fact, I've almost never seen it any other way, enterprise value to revenue. Tech stocks are almost always EV to EBITDA. It's just, and we'll talk about why that's the case. And this is one of the things that the Martin really makes the point is you got to make sure you're using the right relative for the right industry. Are you going to be misstating the value? You're going to be finding companies that look cheap and they're really not cheap. You're just using the wrong factor. Relative value analysis is not asking if the stock's overvalued or undervalued. It's asking if it's relatively overvalued, undervalued. So we're assuming the whole market's well valued. We're just trying to find what are those stocks that are relatively cheaper versus the overall market. It still helps you if the overall stock market's overvalued. If everything's overvalued, you're still better off buying the cheaper ones than the more expensive ones, and that's what relative value is trying to do for you. And what words do we use? I hate these words. I don't know who invented these words, but we use cheap and rich. I would have used inexpensive and expensive, but they use cheap and rich. Cheap just sounds bad, right? A cheap stock, but inexpensive stock, expensive stock. What's the other term people use? Value and growth, right? Value stocks are cheap, growth stocks are expensive. Now, I'm a little bit overusing that because we're talking relative. So a tech stock might be a growth stock, but it's cheap versus other tech stocks. So not all cheap stocks are value stocks, not all rich stocks are growth stocks, but there is some overlap between those two. So if you interview, use the words cheap and rich, even though I don't think they really do that very. All right, so let's use a real estate example. I just saw an article today that real estate prices just hit another record. up strong this last year, even with, people think mortgage rates are going to slow it down, and it looks like the housing market's doing okay. So let's say you're in San Antonio, you see a house being offered for $150,000. Are you going to buy it? That's the only information you have. Does that sound like sufficient information to you? Probably not. Sounds cheap, doesn't it? $150,000 house in San Antonio. Well, let's say there's two other houses in the same neighborhood. So this is like being in the same industry. One's 875,000, one's 675,000. Now, do you buy it now? Is that enough information? It's more tempting. You're probably thinking, well, the house is probably a dump, but I could probably tear the house down, build a new house, and sell it for more. Who knows? But that's 150,000 bucks you're doing versus just buying a vacant lot. Still not enough information, but you're at least in the right industries. So we have to do a little bit more analysis here. So let's use a price relative, right? So you don't have a price relative here. All you have is the same industry and the same neighborhood. But that's not information. So a price relative is price per square foot. You're taking a market value and dividing it by non-market value. Price per square foot. So this house is going for $75 per square foot. Comparable houses were going for $250 and $225. You now know this is a cheap house because you adjusted it for the size of the house. So you now know it's a cheap house. But do you buy it now? You'd probably be more tempted now because you think, you know what, it may be a horrible house, but I could remodel it. I love those remodeling shows. I don't know if y'all do what I do, but I click the last 5 minutes and just watch the makeover. I don't want to watch the entire drama throughout the whole thing. But to me, it's interesting that some of these houses just look like dumps, and at the end, it's like, man, that's a place I'd love to live. I love the decorating, all that kind of stuff. So you might be thinking that way, but you would still probably want to see the house, know what's going on. So is there a way we can get it better? But right now we have a price relative, a market value over a non-market value. So what you have to do, we're going to do this next week. You need to somehow regress this against value measures and risk measures, and that you have to have both value and risk. If you only focus on value, you might find a stock that looks cheap, but it's just really risky. They got way too much debt. If you only focus on risk, you might have a firm that doesn't look all that risky, but they're going out of business, like a Bed Bath and Beyond. And then you got a problem there. So what could you look at for a house? And I don't know what you look at. I did see someone had a model that they provide on the internet. I don't know how much they charge for it, but they have all of these factors, and they have a very high correlation between their factors and actual housing prices. So you could use their model to try to find what's important to you. But what we're trying to do, and we'll see this next week. So there's two questions. What's important to the market? We're going to figure that out first, but then we're going to ask what's important to us. It would be important, wouldn't it, to figure out what is the market pricing off of? What does the market consider important? But then you may say, I don't care about the quality of the schools. I don't have any kids. And if the quality of schools is raising the price another 20%, or maybe the schools are low quality, and that's going to save me 20%. I might say, hey, that's what I want. I don't care about the quality of schools. Someone else might say, I don't care about the garage size. I'm going to be parked outside anyway. What does that add? So, but at the first pass, we're going to ask, what does the market care about? How do we get so we explain why the market is pricing this stock more expensive than another one? On risk, I don't know what there would be on risk. Floodplain foundation issues. That was the issue I had selling my mom's house. There was obviously foundation issues, but we had fixed it, and we had a guarantee that if anything happened to the foundation, they would redo it, and the firm that had the guarantee was still in business. So we had to address that foundation. It probably took some value off of the house, but at least I had the guarantee. I don't know how many people care about the nearest fire department, but that might be important. Annoying neighbors. I love the annoying neighbor TV shows. Those are pretty funny as well. That could be important. I don't know what other things could go in here. One thing I'm interested in that's not on here is just ease of travel. There was one condo I was going to buy, but it was on the worst street. And I imagine myself trying to turn left to go to work. And it was like, I'm not doing this. This is terrible. So there are other things we could put in there. We're gonna make this real simple next week because Bloomberg has one factor that covers everything. That makes it really nice for us. But we'll talk about what the other factors would be, but Bloomberg has in one ratio everything you could possibly think of. So we're just going to rely on that. So that makes the risk side really easy for us. All right. So things related to value, things related to risk. Let's see, I ran all of those factors and I got an R squared 91%. I could explain housing prices, 91% of the volatility in housing prices based on 350 houses sold. And based on that model, this house should be trading for $150 per square foot, but I can buy it for 75. Now, is this enough for you to buy? What would you want to do with that model? I would want to take that model and adjust it to what's important to me and see what it would be trading for. I'd want to see what in that model is driving the value to 150. What I'm hoping is what's driving it to 150 is something that's not important to me. And if that's the case, I'm getting a really sweet deal here. If that's not the case, I'm going to be nervous about buying it. So if the main thing that's driving it to the higher value is the number of bedrooms, it's got 4 bedrooms, and I don't want 4 bedrooms. To me, more rooms is more things to clean. I might say, you know what, that's not, I don't want to. I'm not going to put that as part of my 150 value. So maybe it's closer to 80 for me or whatever. But this is what the average buyer out there finds important. They'd be willing to pay 150. Now we still have a serious problem, which you're going to have to address next week. Why are they selling this for 75 when it's obviously worth 150? It still makes you nervous, doesn't it? There's something going on with this that makes us nervous. So you're also always looking for more factors. I'm going to give you all a trick next week to get your R square higher. I think it's a fine trick to do, but it's going to make you a little nervous as well to try to get the R square higher. When we do that, you're going to have cheap stocks and you're going to be asking the question, why is this stock cheap if this is really what the market's looking at? So that's always in the back of your mind. I'm missing something. Let's say here we're missing 2 things. We can get our R squared much higher if we added these 2 things. Was anyone murdered in the house? And is the house considered haunted? Are there houses considered haunted? And with that influence here. So where I ride my bike in Helotes, the last party I went to, their 2019 holiday party. They're going to have one again this year. They haven't had one since COVID. But one of the ladies there was talking about how her house was haunted. And she had all these stories. And I started laughing. I thought she was joking, but she wasn't joking. So I had to kind of hold my laugh back. But she's a really good storyteller. So it was really fascinating. I don't know if you'd want to be bragging about that if you're going to try to sell your house at some point. But when you do that, you get a much higher R squared and the value drops from 150 down to 80. So now you know something. And that's what we're going to try next week. We're going to see if we can add another factor. If there's something we're missing. Now, fortunately, very few of y'all are doing tech stocks. It's really hard to get these models to work for tech stocks. They work really well for industrials. They work really well for consumer. And so we're probably going to be able to get pretty good models. Tech stocks, it's tough. The reason it's tough for tech stocks is all of the factors we're looking at are historical factors. And tech stocks are really focused on the future. And so we'll try to find some ways to bring that in, but I don't know if I can't remember any of y'all having a tech stock at all, right? So we probably won't have that issue. So here's 2 factors that are probably the reason this house is selling for 75 bucks. And let's say you don't care about those 2 things. You don't care if anyone's murdered in the house. You don't believe in ghosts. None of that bothering you. So you're getting a house that based on the things you think are important, it's worth 150. But because of 2 things you don't care about, you can get it for 80 bucks. That sounds like a pretty good deal, except for what? What if you're planning on selling a house in 2 years? Then it's a problem, right? Because when you sell it in 2 years, you're back to people looking at those two factors. If you're going to live in it, if you're Warren Buffett and you're going to hold this as a long-term business, you're going to buy it for the 75 bucks because you think it's worth 150. If you need to sell it in 2 years, you're going to have to worry about the 80 bucks in the haunted house and those kind of things. So we need to figure out what does the market think is important? What do we think is important? How does ours change? And how long is our holding period? One thing you can say, and this is something that I think is really, really important, is if you believe what the market thinks is important is going to come around and the market's going to learn they were wrong, then that's a good reason to buy the stock now, because eventually they're going to learn they were wrong and the market stock price is going to go back to where you think. All right. So there's a lot of things you can do with these models. The real goal you're trying to do is figure out where your stock falls on this cheap and richness. Okay. So eventually, it's essentially what you can do is you're going to build a model and then you write your paper to explain the model, which is really simple. I'm going to show you really fast ways you can do to explain your model. All right, questions on relative value with real estate. Pretty natural way to do real estate. I mean, you can disagree with all the factors I had. I couldn't find the model that was advertised. And I don't know how Zillow does it. Zillow was pretty accurate on my mom's house. I was pretty shocked. And it moved fast. This was during the time where all the, was it Tesla moving to Austin, where all the Tesla people were moving and the housing prices were just shooting up. And my real estate agent said, this is a really terrible house. It's just not designed. People want houses like this anymore. But people are desperate for houses and the value shot up. They've come back down since. It's probably 25% lower than it was. But yeah, I mean, Zillow was pretty close to what we actually ended up getting, which is impressive, right? Because they haven't seen my mom's house. They don't know that much about my mom's house, and they got it, within 5% of what we actually sold it for. All right, so that's relative value analysis. Ignores whether the entire housing market is too expensive. There are factors that ask if the housing market is expensive. That's the rent to ownership. You compare rent rates to mortgage rates. There are factors out there that do that, but that's not what we're asking here. We're saying, assuming we're going to buy a house, is this house expensive relative to other houses in the area? So for relative analysis to be good, you got to use the right price relative. For housing, it's pretty easy. It's just the price of the house. And you want to adjust it for fundamentals related to value and risk factors. As much as you can, you want to get as specific to your industry as possible. We'll talk on Thursday what kind of factors we could bring in. And the reason I want to do that is when we get together next week, I want you to be somewhat thinking ahead so you're ready to bring in factors. And you try to get your Bloomberg account set up before next week. We found one Bloomberg machine that wasn't working. So we'll have to see if that's going to be an issue. I need to go and test them all, but it takes forever to test them all, but hopefully they'll be working. But we will be using some generics industries factors. So a good example is you're doing Costco. A great turnover ratio for Costco is revenue per square foot. But if we're bringing all the consumer staples, probably 60% of them won't have revenue per square foot. So can we find a substitute for that? Or do we just limit the firm? So Amazon, revenue per square foot doesn't make sense for Amazon because they sell almost everything's online. So we'd like to have the specific, but we can't because it's going to get too many NAs. If you're doing airlines and you have a model just of 13 airlines, you can do available seat miles, which is a perfect factor for airlines because they all have that factor. So the more you limit yourself, the more specific you can get, but the less statistics you're going to have. So that's the question you're going to have to address next week. All right. All right. So all three must be in place. If you're missing one of them, we're going to build a model next week to have all of them in place. That won't be an issue. So think of it as a regression. Your fundamental and risk factors, they're the independent variables trying to forecast your relative value. That's your dependent. Just like with the house, all those factors explaining housing, we're trying to get those to figure out the price of the house. So that's what we're trying to figure out here. You're not actually trying to figure out the price of the stock. You're trying to figure out the relative price of the stock. Is that revenue, that price per square foot kind of thing. Higher fundamental values, your stock should be richer. Higher risk factors, your stock should be cheaper. Okay, pretty straightforward, pretty obvious. All right, so this you're going to need for paper 7. So think back to the Gordon growth model. I've simplified it, but the price of a stock is dividend divided by discount rate minus G. What is a dividend? A dividend is earnings per share times payout. Y'all agree with that? Your earnings per share times your payout. So price equals earnings per share times payout divided by risk-free rate times beta. I'm kicking out the KE times the market risk premium. There's your CAPM minus growth. How do we turn this into a PE ratio? We just divide both sides by earnings. And that gives you what? A PE ratio. I would memorize this. If you're interviewing for a job, this is a formula I would absolutely know off the top of my head. There's a massive amount of information in this formula. So what is a PE ratio? It's the payout ratio. You'll see how I got the PE ratio. I'll move earnings over here, price to earnings. Is the payout ratio divided by interest rates, the risk-free rate, plus the firm specific risk times overall stock market risk minus the firm's growth. We have 3 things that are specific to the company: the payout, the beta, and the growth. Those are specific to the company. There's 2 things that are systematic: interest rates and the market risk premium. Okay. So understanding PE ratios. What do interest rates do to PE ratios? If interest rates go up, you raise this number, what is this number going to do? Higher interest rates, it's in the denominator, so what happens to the PE ratio? It's going to go lower. Is that true? When interest rates are higher, PE ratio is lower. Absolutely. What were PE ratios in 1980? They're like 7 or 8. And why was that? Because interest rates are really, really, really high. What are they now? They're like 20 something. A couple years ago, they were 20 something. Right now, they've come down some because we've had somewhat of a sell-off. The stock market has not liked higher interest rates because the higher interest rates are causing pressure on these valuations. Now, it's a little tricky. We'll talk about the interplay between some of these, but if the only thing that changes is interest rates, PE ratios will be lower. Now, there is a factor related to interest rates that's even more important. That's inflation. There's a strong relationship between inflation and PE ratios. When inflation's high, PE ratios are low. When inflation's low, PE ratios are high. And that you can see there's a higher correlation between inflation than there is the interest rates, but there's decent correlation between both. And it is a negative correlation. Market risk premium. If everybody's worried and the VIX ratio is high, your market risk premium is higher, what are PE ratios going to do? They're going to be much lower, right? So what happened in 2008? 2008, interest rates fell. What did market risk premium do? It shot up. So what did PE ratios do? You had these countervailing factors. PE ratios fell. Why? Because risk premiums shot up a lot more than interest rates fell. And that's the normal, right? Y'all know there's a relationship between these 2, right? When everybody's worried, what do interest rates do? They generally fall. So generally, this is going to dominate that. Now, what happened in 2022? Market risk premium rose, interest rates rose. Why? Because of inflation. That's why there's a stronger relationship between inflation than there is between interest rates. All right, so 2020, y'all remember 2022, the stock market sold off 20% because risk rose and interest rates rose, double whammy, caused PE ratios to come down. stock market fell. But generally, there's a negative relationship between these two. Generally, if you have a recession, the risk premium rises, but the interest rates fall. So you get a little bit of offset, but usually the market risk premium dominates everything. When investors are worried, scared to death, stock prices are going to fall. Questions on those two? So have a good understanding of how PE ratios are influenced by interest rates and betas. I mean, market risk premiums. All right, beta. Beta is pretty straightforward. Riskier companies with higher betas are going to have what kind of PE ratios? Higher beta, what happens here? Lower PE ratios. So you have to question, is my stock cheap or is it just really risky? And it could be both. It could be really risky, but it could even be cheaper more. You're overreacting. All right, so high beta stocks are cheaper than lower beta stocks. And then growth, we're subtracting growth. So high growth companies, since we're subtracting this, what are their PE ratios going to be? They're going to be higher, right? Because we're subtracting growth. So these are the two factors I talked about. Risk, higher risk, lower valuations. Growth, that's the fundamentals. Higher growth, higher PE ratios. So all of that is in the formula. You have things that relate to the overall economy. You have things specific to your company. These two things, risk-free rate, market risk premium, are going to affect all companies equally, not your company specifically. Beta and growth are going to be specific to your company. I left out one thing. What did I leave out? It's one thing I'm going to talk. Y'all really fight tonight. Payout ratio. All right, I'll answer it for you. Why do we ignore payout ratio? Any remember a theory we talked about a couple of classes ago? Sustainable growth. Anybody remember that? What did it say growth equals? ROE times retention. What is retention? 1 minus the payout. What does financial theory say? If payout goes up, what does growth do? Goes down. Finance assumes these two are perfectly offsetting. So we don't have to worry about payoff. You pay out more, your growth comes down, it's a wash. Your payout goes down, your growth goes up, it's a wash. All right. Does that work in real life? No. But because it's the annual, it doesn't work. Because in real life, during a recession, growth goes down and payouts also go down because firms are scared to death. So, but over the long term, it's probably true. If firms pay out more, they're going to grow more slowly. If they pay out less, they can grow faster. But in a crisis, you're probably going to see both the payout and the growth decline because firms are just scared to death. So it's a great formula to keep track of. There's a lot of financial theory. Now, can we do other ratios like price to book or EV to sales, those other ratios? You can, but the formula gets a lot more complicated. So if I were you, I'd stick with this formula. I would know this formula off the top of your head. It's a really good way to think about a stock. And so what we're trying to do is once we adjust the firm for risk and for fundamentals, does this PE ratio make sense once we make that adjustment? Now, remember the file I showed y'all last class, you had a target relative that you're going to put in. So you need to figure out what that is. And this formula is going to help you do that. All right. We'll talk about that some next week once we get all the data together. So what should the PE ratio of your firm be? What should the EV sales of your firm be? And we'll be able to back into that when we build the model. Any questions on this? Really powerful stuff, really helpful. All right. So these are old numbers. I think some of these have corrected, but we can still talk about them. I don't have any of y'all's companies in here. So at the time I did this, it's been a few weeks I did this, but Tesla was 1,000 times earnings. Kroger was 11 times. Walmart was 29. Amazon was 77. I don't know what they are today. Tesla's come down quite a bit. So what's the cheapest stock up there? Kroger's. What's the most expensive stock? Tesla. So is Kroger's cheap? They are cheap. You can say it's a cheap. This is a value stock. But is Kroger slow growth? Possibly. I'm real impressed. Have any of y'all done the Kroger's here in town? Have y'all tried that? There's no store, but they have, yeah, they deliver from a warehouse. I think it's really interesting. None of y'all use it. So I don't know why someone would use it if there's an HEB right on the corner, but you know, it's tempting. I should go out and see what they're doing. It's interesting. Like Kroger's without us. So they're trying stuff. They're getting beat up by Amazon. They're probably getting beat up by HEB in Texas. Kroger's, and they bought out Albertsons, right? Then they buy out Albertsons. So it's interesting. Grocery store is not a high growth industry, but they are trying new things to try to generate some growth. But is that why they're so cheap? They just don't have much growth. Or is it possible that they're high risk? Well, Kroger's has a lot of debt because they have been trying all these things. So they're definitely high risk. They have a lot of debt, but they're high risk because of the debt, but they're also low risk because they're a consumer staple. So, you know, how much do you adjust for the fact they have high debt? How much do you adjust for the fact that they're low beta? Their high debt's going to raise their beta, but they're still going to be a lower than average beta. Now, is Tesla rich? Yeah, probably at the time I did this, since they've come down. Are they high growth? Yeah, people think, you know, in California, you won't be able to buy a gas car here in a few years. They've got some good competition coming from China, but still they have somewhat of a reputation. Are they low risk? I don't think a Tesla is low risk. So that's certainly not it. So what we're going to try to do with our models next week is answer that question. Is it cheap? Is it slow growth, or is it high risk? Is it rich? Is it high growth, or is it lower risk? So Walmart. Why does Walmart look so expensive? Is it because it's high growth, low risk, or overpriced? So when I did the model, I looked at it, it looked overpriced to me. I don't think of it as high growth, but I do think of it as low risk. So I got to figure out. Now I adjusted for the low risk by my beta being low. So I was already adjusting for that. And even after that, they look expensive to me. So I do think Walmart looks expensive to me, but I've adjusted as much as I can for the growth and the low risk. So that's the question we're trying to answer. Amazon, could you think of Amazon as low risk? I do think AWS is a pretty stable business, mainly because Netflix and some of the other firms are just desperately dependent on them. It is a pretty stable, although they had some blowups with AWS here recently. I could think of, you would normally think of that kind of technology as being higher beta, but it's kind of low. Amazon online, you're selling discretionary and staples. Whole Foods is kind of a higher, low beta kind of company, below one, but not Walmart. So, you know, those kind of questions you're asking, I would think of Amazon as being overpriced. Me personally, I've never owned Amazon as a stock. Obviously, I got that wrong given what they've done, but they seem expensive to me. So that's what we're going to try to answer for your company. All right. All right. So let's make sure we understand the factors here. So 2 choices, price or enterprise value. Price is stockholders only. Enterprise value is stockholders and bondholders. The denominators, we're going to use earnings per share, EBIT, and EBITDA. We're going to use book value. We're going to use revenue. Those are the 3 we're going to use. Now, Dante, and who else is doing Chipotle? I can't remember. Who? Oh, Mohammed. Okay. Mohammed. Okay, so you can't use price to book value for restaurants because you have so many that have negative book value, but you wouldn't use price to book value to them anyway. So we'll talk about which one to use, but earnings can't be negative for it to work. So that's one advantage of EBITDA. There's a lot of firms that have negative earnings, but positive EBITDA because you're adding so much stuff back. Book value can't be negative. So if your firm has negative book value, even if that's the appropriate ratio for your firm, we can't use it because we can't have your firm with an NA. Revenue is wonderful because everybody has revenue. So it works for everybody. So we'll try all 3 of these. What you're going to see we're going to have to do is get rid of the NAs. I'm going to show you some tricks to get rid of the NAs. But what you don't want to do is if you have one particular factor where 80% of the firms are NAs, what you're gonna have to do is try to find another factor to substitute for it, so you're not deleting all these companies. All right. So NAs not available is a huge factor for you. So for retailers, we'll probably bring in book value, but if we see too many NAs on book value, we'll probably just get rid of it because we know it's going to use the revenue one. So there's sometimes where we'll say, just throw in the towel and get rid of that factor. All right. So you'll see next week when we build it. All right. So the question is, when do you use price? When do you use earnings? When do you use enterprise value? When do you use all of these factors? So the key is the capital provider, whether stockholders or stockholders and bondholders, must match the denominator. And I think it's really simple, but I asked this question on my investment exam, and about 30% of students miss it on that exam. So I don't know, did y'all get it right last semester? So I thought it was a simple question, but some just didn't make the connection. So if the denominator is before interest expense, you use enterprise value. Because if it's before interest expense, it belongs to both the debt holders and the stockholders. All right, so anything that's before interest expense, EBIT, EBITDA, and revenue, those three are before interest expense, use enterprise value. Anything that's after interest expense, earnings per share and book value, use price. There's no such thing as EV to book value. There's no such thing to EV to earnings per share. There's no such thing as price to EBITDA. It's going to be EV to EBITDA. If you go out to Yahoo Finance, though, are y'all going to watch the Fed tomorrow? See what they have to say. There he is right there. He knows what people are expecting, right? And the Fed has an incentive, if they're expecting the wrong thing, to throw out some hints. So probably that's going to be correct. So here's Walmart. So there's the PE ratio. You can see they have two PE ratios, trailing and forward. Remember on the PEG ratio, they're using the forward. So trailing and forward, there's the PEG ratio. Book price to book is good. Enterprise value to revenue is good. Enterprise value to EBITDA. The one error on Yahoo Finance is there's no such thing as price to sales. Right? So it's one error they have. Don't use price to sales. If you use price to sales, you can get stocks that look cheap. They're not cheap. They just have a whole lot of debt, and you use the wrong factor. All right. So here are the three categories: earnings base, book value base, and revenue base. So we probably will not use price to earnings next week. We'll probably use EV to EBITDA just because it eliminates a lot of the NAs because you don't get as many negative numbers. On tech stocks, if we had any tech stocks, we would try the PEG ratio. The problem with the PEG ratio, you get a lot of NAs on that as well. But it would be interesting. So for all of your firms, we're going to use EV to EBITDA, but tech stocks are the ones we really want focused on EV to EBITDA. Enterprise value to earnings for interest, taxes, depreciation, amortization. Book value base, price to book value, but one I really, really like is price to many years of earnings per share. So let's say, Jay, you should probably we'll talk about price to book value is what you're going to use for your firm. But let's say you get too many NAs on book value. And that's because a firm like Boeing has bought so much, or well, Boeing had losses. A firm that bought so much of their shares back, they have negative net worth. If you do price to 10 years of earnings per share, you don't get that negative number. And think about what book value is. What is book value? It's their earnings per share since inception, minus what they paid in dividends. So instead of using book value, we can use earnings per share over multiple years. And I believe, we'll have to look, I believe Bloomberg has a factor like that we can use. So Jay will look, and if you see you're getting like 20, 30% NAs, we'll try that factor instead. So there's ways we can substitute to try to get rid of the NAs. And then revenue base is the simplest because you really don't get any. If you get an NA on EV, the sales, is like, what's wrong with this company? What firm has negative sales or has zero sales? So any of those companies have NAs, we probably want to kick them out anyway. They don't make any sense. Okay. So now the question is which factor to use with which industry? And I think this is pretty simple as well. So earnings based are used by industries really focused on growth in earnings, growth in revenue. So tech stocks almost always use EV to EBITDA. Now, I will tell you a ratio I really, really like. We don't have any tech stocks, so I'm kind of wasting y'all's time, but for other purposes, right? And some of y'all may want to use this ratio for your industry. So PEG ratio is, so a PE ratio, you're just looking at the PE over price. You don't have any fundamentals, you don't have any risk. What a PEG ratio does is it brings one of the fundamentals in. It brings growth in. So it's kind of like in one ratio, you have everything but the risk side. So someone needs to develop a PEG ratio that also includes risk. So remember, you need the PE ratio, you need a fundamental, you have your risk factors. So PEG ratio has the fundamental, it has the PE ratio and has fundamental. But this uses forward PE to expected future growth. And you get a lot of NAs because a lot of firms don't have forecasts of earnings. So this is a ratio I was thinking of, and I was talking to Jason, who was the alum who's, or actually USA, the guy I worked with at USA. He's a tech analyst, really good. I really should get him to speak to this class again if I can find him. I could probably find him on LinkedIn. But he and I were talking about this is a historical PEG ratio. And I love this ratio. So what it does is trailing PE to trailing growth. I don't think Bloomberg has this, but it wouldn't be that difficult to get. You just bring in the trailing PE. Bloomberg does have 5 years EPS growth. They do have trailing growth. So this to me is a very interesting one. So some of y'all might make note of that, and you might want to try it next week for your model. Could be really, really interesting. So PEG ratio works great for tech because everybody's focused on the future, but for other companies, PE to trailing growth can be really, really quite interesting. Questions on that? I've tried it and we've had some really, really good success with it. It actually worked somewhat decently with tech stocks, actually. So because we couldn't get the PEG ratios we wanted. All right. So if you have a tech stock, EV to EBITDA. Book value base works for 3 types of companies. One is manufacturing. So I'd probably put UPS in here. We're talking about firms that have a lot of property, plant, and equipment. So look at your firm's balance sheet. If property, plant, and equipment's 40, 50% of assets, you probably want to go with price to book. Right? Your firm has a lot of tracks and trains, right? You look at the balance sheet and just see how large that is. So utilities, manufacturing, UPS probably owns all these trucks and airplanes. That makes a lot of sense. So a firm like Packer that builds diesel engines, those kind of firms, price to book makes the most sense. The second group of companies are the cyclical ones, like a Valero or an Exxon, those that sell some kind of commodity where their earnings are up and down with the commodity. You want to use book value base because you want to somewhat kind of put a line through all that volatility. Otherwise, after a year like 2020, when oil prices fell, Exxon's going to look really expensive because their earnings are down. And then a year like 2022, they're going to look really cheap because their earnings are up because oil prices are up. And so using a price to book value somewhat fixes that. And this is especially with cyclical companies where I really like price to 10 years of earnings. I think it works really, really well because then what you want to do is look at their earnings through the cycle. Otherwise, if at the top of the cycle, they look cheap. If at the bottom of the cycle, they look rich. You're just getting really, really bad information. So price to 10 years of earnings. We'll have to check Bloomberg and see if they have that ratio. And then the last one doesn't apply to any of y'all, and that's banks and insurance companies. So like I wouldn't use it for Visa or PayPal. You're not going to use it for those firms. So none of y'all have banks and insurance companies. Price to book is always banks. The interesting thing with banks, my whole career with banks was banks should have a price to book of 2 to 1. And look at Bank of America. Their price to book is 0.85. Bank of America is trading cheaper than what the accountants say it's worth. And the accountants are supposedly following GAAP accounting, which is supposed to be conservative. So really strange that banks are trading below 1. That's really bizarre. JP Morgan's the exception, but even they are not that rich. They're at 1.5. So, you know, my whole career, 2 to 1. It's real obvious. Banks should be 2 to 1 if they're less than that. So look at Citibank. Citibank is really fascinating. Their price to book is 0.42. They're worth less than half of what the accountants say they're worth. What is on their balance sheet? You know, accountants are supposed to be doing fair value accounting. What is the stock market telling us about Citibank that they think they're worth half of what the accountants think? And then my ultimate one, Genworth. What is Genworth? Well, they're not as low as they've been. They were at 15. And think about it, you can buy a stock 85% cheaper than what the accountants say it's worth when the accountants are doing, you know, supposedly conservative accounting. You compare that to Tesla. Price to book of 23 or 17. You know, tech stocks, you're paying 10 times more than what the accountants say it's worth. So a huge difference, right? We wouldn't use price to book for a tech company anyway. It wouldn't make any sense. But for banks, it makes a lot of sense. Amazon, their price to book, not quite as extreme, but 8 times. So you can see banks are really unusual. I can throw a life insurance company in there. They're a little bit above. They're more like what JP Morgan is, but so it is a strange world right now. It's hard for me to explain why. And one of the things that really bothers me about banks is they look cheap, but supposedly they're much better capitalized today, which means they're lower risk. If they're lower risk, what should their value be? It should be higher. So if they're lower risk, why are their values lower? It's a really bizarre. I'm not saying go out and buy a bunch of bank stocks, but I'm just saying there's something strange going on with the industry. Don't you wish you could talk to a bank analyst and see what's going on with this? It seems like 2008 just was so negative on banks, we haven't gotten back to them being normal again. So, all right. So a few of y'all are going to fall on this book value based relatives. Now, Huang, you might be on the earnings base. You might classify Visa as a tech stock. So you can see, we'll try both, right? It might fall into retail, but I would think of Visa more as a tech stock. Who else was Visa? I can't remember. Derek, what were you? I can't remember. Qualcomm. Yeah, you're going to be in. Okay, so you are a tech stock. So you're going to definitely be on earnings. So with Qualcomm, Derek has somewhat of an advantage. So he can just take semiconductors and run his whole model off on that. And we probably can get some specific ratios for semiconductors that we can run. So that gives you a little bit, you have a fairly well-contained industry that helps quite a bit. The challenge you're going to have is you got the fab companies and the non-fab. So we'll see. We may do some stratifying. I'll show you all how we can do some stratifying. Healthcare is a good example. So Luis, if he were here, he can just do pharma, but he might kick out the biopharma. So there's times where you say, you know, at this part of this, we may not have time next week, we'll see, but What I like to do is bring in the sub-industries, and I like to run my R squared against the sub-industries and see if there's one sub-industry that's really messing up my model. We'll see if we can do it if we have time. It may be something I'll save to the end, and then you can do it yourself with your own model. But you see how powerful that could be. If you have 10 sub-industries, and 8 of them have an R square of 0.92, but 2 of them R square of 0.1, say, let's kick those 2 out. They're definitely a different industry. So it can be really, really quite powerful to do. And it's not that difficult to do because you got all the data sitting there. You just got to run your R squared. So I would think of Visa as being earnings based, Qualcomm earnings based, and just semiconductors. Revenue base is all the retail. Anyone focused on margins, you want an EV to EBITDA. Now, what we have found with models in the past, we put the 3 in there: EV to EBITDA, price to book, and EV to revenue. And we tell the model to pick the one that has the most predictive value. Consumer stocks always go 100% to EV to revenues. But what we discovered in some quarters is that tech stocks will go 100% EV to sales. Banks almost always 100% price to book. So it kind of depends. There are some industries that shouldn't be in this category, but for some reason they get put in that category. I've never seen tech go to price to book ever. So tech doesn't make sense there. But I have seen tech go revenue based. If we find that, we'll just go with revenue based because it's just what the model is telling us. So we're going to model to be based on R squared. Which of these factors give us the highest correlation with what the market thinks? All right. Questions on this? This is really important to understand. Everybody know where your firm. So Lance, where does your firm go? Oh, your tech. Which? Yeah, so Visa, MasterCard. So yeah, I would do the earnings base. That makes sense. Sorry, I can't remember y'all's companies. You're going to be retail. I would do the price to book. I really would. Yeah, so again, go to Yahoo Finance and see. I could be wrong, so because I don't, a lot of these firms do some interesting things. So go to Yahoo Finance, go to financials, and do balance sheet. And what you're trying to see is how big is their property, plant, and equipment. So you can see their property, plant, and equipment's over half their assets. That implies price to book. Or if I do a tech company, their PP&E, look at that. It's 3 billion out of 48 billion. Netflix, I would probably put under tech. I might put it under retail, under tech. But see how small their property, plant, equipment is? So price to book doesn't make sense. Jay, remind me, I can never remember your company's ticker. ODFL. Yeah, I don't buy stocks that I can't remember their tickers, so I would never buy Jay's stock, but that's not a good reason to kick it out. Oh, sorry, I must have typed it wrong. No, it's there. What's not able? What happened? Did your firm go out of business? There it is. Okay. Yeah, that's if I have the right company. Do I have the right company? Yeah, so he's almost 70% fixed assets. So yeah, price to book makes the most sense for your firm. And if you look at the price to book, it might be lower just because of that. No, it's actually quite high. Wow, that's amazing. And that could be because, that's one reason you have to watch real carefully. If they've been buying a lot of stock back, that can really distort. Yeah, in that case, that's where the price to 10 years of earnings becomes a much better factor. So if a firm buys a lot of stock, but you get an elevated price to book because their book value is so low. So you can see the kind of things we got to think through. I want y'all thinking about that before we get there so you're ready next week. So we're not like spending 30 minutes on trying to get one person set up because it's going to be frustrating for everybody else. All right. So everybody sees, anybody not sure? Alex, I can't remember your company. Yeah, I would do the tech for them. Yeah.
They do a bank in Luxembourg though. that's the only bank they have, but it's like.
Yeah, it's probably small enough. Yeah. Yeah, it's interesting. PayPal was one of the most sold off stocks the last 52 weeks. So it's down a lot. So maybe it's a cheap stock now. So kind of interesting. Why it's reacting like that? Interesting. Um, the other thing you can do in paper 7 is if you have 2 or 3 key competitors, and I'm going to show you a file on Thursday that you can get out of Capital IQ, which you can do some really cool analysis where they do this relative analysis on key competitors. It's really quite fascinating. Anybody else? Genesis, I can't remember yours. UPS, okay. And Alejandro, you switched to. Oh, you're doing deers. So yeah, price the book. I would think on deer would make sense. Did I catch everybody?
Just to make sure, Professor, if mine is price to book, right?
Yeah, price the book, unless the other problem Jay has where they bought a lot of stock back then, we'll probably do price to 10 years of earnings. I'll look and see if Bloomberg has that. So that'd be really, I love that ratio. So I almost want to use it just anyway. And Julia, I would probably say tech on yours. It's kind of that techie kind of thing, but we'll see. We're gonna bring them all in, so we'll let the model tell us, but I would probably be more techie on that. So, all right. This anybody? Kaylin. Retail, yeah, that one's straightforward. Yeah, EV to sales, that one even won't give you a question. And so that's the key. Let's think of Lululemon. So Lululemon, wow, they look expensive. But then you bring their gross margin in and say, well, wow, their gross margins are high. So you're going to adjust for that, right? Walmart's going to look, when we adjust them, firms are going to look rich or cheap depending on their gross margin. If you have a firm with a really thin, I'm going to have to think about through this. I'm probably saying it backwards. But a firm with a really thin gross margin is going to look really expensive. Am I saying that right? No, look really cheap. I said it backwards. So Walmart looks really cheap on the EV of the revenue. And Lululemon looks expensive on EV of the revenue. But Lululemon gets to keep a lot more of the revenue than Walmart does. So once you adjust the model, if you just look at EV of the revenue, you say, well, buy Walmart and avoid Lululemon. But once you adjust for gross margin, now you're not so sure. And that's what the model is going to do for you. You say, yeah, but you're willing to pay more for Lululemon because they get to keep more of their revenue. So that's really the key what these models are doing. So what can you do? You can build a screening model. That's essentially what we're going to build, but we're going to focus in on your company. We're not doing a screening model to do a buy list and a sell list. We're doing it to see where your firm sets in. So you could also do this with bonds. I've actually not tried this, but you could use OAS or CDS spreads and credit ratings to try to figure out if a bond's overpriced or underpriced. You can do this to value a non-publicly traded company. If I were valuing HEB, I would use EV to sales and compare the Kroger's and some of the others, but I would adjust it for debt, right? I could build a model with all grocery stores, and then I could plug HEB numbers in, and it would tell me what their EV to sales should be based on their debt, based on their EV, their revenue to square foot, and all those kind of things. So it's pretty powerful. If USAA were to sell their bank, what would they look at? What ratio would they look at, do you think? Well, first of all, what's the comparison company? The closest company to USA's bank is Capital One. So which ratio would they pick? Price to book. And Capital One's trading about 75% price to book. That's probably about what USA would be looking at. They would probably bring in multiple banks. So Colin Frost. Look at Colin Frost. Colin Frost is, why do people love Colin Frost so much? You may know what's the big, there's a 2-to-1 bank, a rarity. What does the market love about Colin Frost? Why does Goldman Sachs want to buy Colin Frost? I know they haven't said that, but they do. There's one ratio. And you have an idea? What does Colin Frost do better than anybody else? Have you ever heard of loan to deposit ratio? Colin Frost has a very low loan to deposit ratio. What does Goldman Sachs desperately want? Deposits. So that's why Colin Frost is so loved. They could loan out a whole lot more money, but they're so conservative. So most banks loan out as much as they can. Colin Frost has these massive deposits, which are great, because they're really cheap. and they haven't fully loaned out their book of business. So they're a very, very expensive bank, but for good reason. So if I were doing banks, loan to deposit ratio is one of the factors I would bring in for the bank, because that would be a real telling reason why that bank is so expensive. So yeah, USA want to sell their bank, which I was surprised they sold their investment company and didn't sell their bank, because their bank, if you watch the news, is all of their problems, right? That's the one that keeps causing them all these headaches. It would be pretty easy to find a buyer for their bank. It's a nice bank. It's got some good qualities to it. Great credit card book, some good deposits, those kind of things. But you would adjust for it. Loan to deposit, how many non-performing assets do they have? Those kind of things would be in there. And then what we're going to try to do is this last one is try to figure out what factors is the market focused in on. So we're going to let the model decide, and then we're going to look at those factors, and maybe for Lululemon, it allocates 5% to gross margin. And Kaylin's going to say, yeah, but I think gross margin is much more important. So I'm going to put 15% in there. So she may adjust it. So those are kind of things. And she's going to talk about that in the paper. So the model, this is what the model said was the keys. Here's what I actually used. And this is where, and then she's going to do a graph and show where Lululemon is versus everybody else. So it's pretty cool stuff. The CFA research team last year did that, or 2 years ago, the team that won, and they got a lot of leverage out of that model. It was pretty interesting. They're the only team to do anything like that. I haven't got any volunteers for the CFA research team, but they did announce the company. It's a cloud-based company. If any of y'all want to, if you got some time in January, you want to get something really cool on your resume, we're running out of time, so you need to let me know here pretty soon. We got 2 graduate students that want to do it, but they need at least 1 more person. But it's a cloud-based company. I forget the name of it. So if you're just like interested, email me and I'll send you the information. You can kind of decide, but you need to decide here pretty soon. Yeah, the team a couple years ago, they used the model that you're going to be building, and it really looked very impressive in their paper. It's really quite eye-opening. So, all right. So there's 2 approaches we could use. When I watched the Motorin's class, he did a regression model, and it worked wonderfully. And so I started doing regression models, and it worked horribly. And I discovered what he showed this class, he found an industry that worked really, really well. So what's the problem with regression? Y'all know how to do regression models probably in Excel. You've probably done that. The problem with a regression model is, let's say we're doing Lululemon, you get a regression model, you get this high R-squared, 96%. You say, oh, this is great. And then you go look at gross margin and the slope is negative. And the regression is telling you, we think firms with low gross margins are more valuable than firms with high gross margin. You go, okay, that makes no sense. I got to kick that out. So you kick that out. You kick out gross margin, you run it again. And now asset turnover goes from a positive slope to a negative slope. Like, oh, I got to kick that out. You keep kicking stuff out at the end. And I've seen some models that say higher debt is more valuable than low debt. It's like, no, I don't like that. You keep trying over and over again, and it just doesn't work. So we're going to use a ranking model. What the advantage you'll see with a ranking model is if the slope goes the wrong direction, it gives a 0 weight to that. All right, so you'll see how we'll do that. It's really simple to do. So a ranking model says, rank on this, but higher is better. And if it higher better doesn't work, it just allocates 0 to that. Okay, so that gives us an advantage. So I use ranking models instead of regression models. I've been doing this for 15, 20 years. It just works a whole lot better. I don't know if the Motorin was here to defend themselves, what he would say, but you can't put a negative slope on turnover and a positive slope on debt, even if it gives you a better R-squared. It just doesn't make sense. All right. So we'll be using ranking models. I'm going to work through some examples on Thursday to get us ready for next week. You could do this yourself and you don't have to come to the session next week if you want to, but you still get the 10% bonus even if you come to the session. Okay. So everybody wants the 10% bonus, right? That's like 1% on your overall grade when you do it. So you want to do that. So, all right. Any questions on any of that? This is really, really powerful, useful stuff. It's actually the kind of stuff, if you took an analyst job, you'd probably be doing it from day 1. And you probably impress some of your peers that you could do this. So You need to learn how to do it because it's pretty powerful. You can do this in Capital IQ. I prefer to do it in Bloomberg because it's easier. Okay. So we're going to do it all in Bloomberg. So you can make sure you have a Bloomberg account. All right, we'll stop it there. All right. So I built the model. I just want to show it to you and what we're trying to build on in our sessions next week. Not just for your paper 7, but I think this is a really good thing to be able to do. You could do this in Capital IQ. We're going to do it in Bloomberg. So you already gotten some experience with Capital IQ with paper 3. So we'll try some Bloomberg. So, so what I did is I brought in all of the consumer staple companies. I also brought in their sub-industry name, and you'll see why I did that. And I even brought in the industry name as well, and you'll see why I did that. And then what I did is I brought in the data. And so if you look at the data, I have data related to top line growth. Those are things like revenue growth. That's the very first one. Asset turnover, everything in that third part of your paper 3. So remember, you have liquidity, solvency, turnover. So these are the turnover ones. I did asset turnover, and the way this formula works, and we'll have to figure out if the formula is pretty complicated. The way this formula works is it says, so if error, have y'all used the if error function before? So what it's saying is BDP, that's Bloomberg data point. This won't work on your machine. I've got the values here so I can actually show you. Bloomberg data point. A5 is the ticker. So for A5, E4 is asset turnover for 2023. And I did it times 1. So if it brings in the NA times 1 gives me an error message. So it says if 2023 gives you an error message, then the same formula again, but brings in 2022. So essentially, if they have 2023 like Walmart, it'll bring in 2023. Otherwise, it brings in 2022. All right. So that's the purpose of that formula. It's not a horrible formula, but it is a little bit involved. So we'll have to figure out, this is what's going to take us the most time in the sessions of getting this formula set up, probably more than anything else. The other thing I can do is bring in turnover 4 years earlier. And so what I'm looking for, I'm not going to actually grade them on this. I'm gonna rank them on their turnover, but I'm also going to rank them on how well their turnover improves or gets worse. So I call it ATO expansion. And all that's doing is taking their ATO for 2023 minus 2019 and just seeing if it's higher or lower. All right. So we're going to rank on that. I bring in sales revenue. We don't really need sales revenue. I'm not sure why I brought it in here, but I brought in sales revenue. I might use it somewhere. I can't remember. And then they have this thing called working capital of the sales. That's pretty helpful. I think the reason I actually had sales turnover in her, I used to bring all the working capital accounts in individually. So it took up a lot of columns, but Bloomberg has this wonderful function, working capital to sales. Obviously you want that number to be lower or negative. So that number bring in, so I'm going to grade them on that, but I'm also going to grade them if it gets better, if it gets more negative. All right. So I'm going to grade them on the working capital, lower is better. And their working capital management is getting lower is better. All right. So I'm grading them on those 2 things. So those are my top line things that essentially covers all 3 of those things that we had under turnover, except for we don't have revenue per square foot or those kind of things. So those special ones you're looking at, revenue per employee, I could try to bring that in. We might try that on some of these, revenue per employee. I mean, Allison, yours is a good example where working capital doesn't really make sense. So we might try our revenue per employee there and see if we can get it. We just don't know for sure, or we might bring in that return thing. So we might do some special things for her, but essentially we're trying to cover those 3 items under turnover. Then we have things related to margin. Gross margin, that's pretty simple. Just bring in gross margin. If you don't have a gross margin, we can substitute something else. Then what I do is EBITDA I bring in EBITDA, and what I'm looking for here, I'm not actually grading EBITDA, so you can't rank firms on EBITDA because otherwise big firms are number one and small firms are, so I don't want to do on firm size. What I'm doing there is I'm looking at the change in EBITDA as a percentage of sales. So I guess I do use sales here. So I go back and divide by sales. So I don't want to just show the percentage change in EBITDA because if they have two negative numbers, then the percentage change could look really good. They go from negative 100 to negative 200, looks like 100% growth. That's not good. So wonderful thing about sales is how often will sales be negative? Not very often. All right. So sales is a wonderful number. So rather than doing the percentage change in EBITDA, I do the change in EBITDA in dollars and divide that by sales. And that gives me a really good indication. Is their earnings growing or is it shrinking? So I'm going to grade them on this. I'm not going to grade them on either one of these, but I am going to grade them on that. The EBITDA margin, the same thing here. I bring in their EBITDA margin, and then I also look at their EBITDA margin expansion, right? So that's all those things on that fourth section of the paper. Gross margin, net margin. But I like the EBITDA margin expansion. The model may not like it, might ignore it entirely, but I can always bring it back in, right? So I've got 1, 2, 3, 4 things there. Got 1, 2, 3, 4, 5 things there. The next section is return on capital. Now there's several options here. The wonderful thing about this spreadsheet I'll show you is once you get it set up, if your model doesn't like some of these things, you can substitute something else real quickly. So ATO times margin is essentially return on assets. It's very similar to return on assets. So I bring that in. WACC, y'all remember EVA? Y'all study EVA, economic value added? Anybody remember? Dante had my class. Mohammed, you were in my class, weren't you? So anyway, y'all remember what EVA? Anybody remember EVA? They did a survey on finance investors, and they classified EVA as the #1 thing they consider. So it sounds like it might be important. No takers. You'll remember when you see it. You should have had it in 3013. So in economic value added is you take the return on capital of the firm and subtract the cost of capital. So you're asking, do they have a higher return than their required return? Weighted average cost of capital is required return. Return on capital is their actual return. So EVA is that spread. The EVA spread is, and a good example here is so this first company, it's minus 672. In 2019, it was 704. So the minus 672 means the return on capital was 1% and their WACC was 7.7%. In 2019, their WACC was 5% and their return on capital was 12%. Right? How well is this first company doing? Would you give them an A or an F? Pretty bad. They're really, really good 4 years ago, and they're really horrible today. All right. The second company, any WACC that's positive is good, so they did well. But what's the problem with this company? They went from 20% to 1%, so not good. I should have gotten rid of these duplicate companies. I should have looked for that. See if we can find a good one here. This one, they're negative, but they've gotten better. That looks like a really strong company there, right? They went from a negative to a highly positive. So that's the kind of thing we're looking for to see. I would actually like to do this over several years, but it just brings in too much data. But we could take it over 5 years and get the average over the 5 years. Something like that would be interesting. So there's other things we could do. So I like the EVA spread. However, most models ignore it. So even though investors say it's the most important thing they look at, most models don't allocate anything to it. But so we're going to grade on return on assets, EVA spread, and the improvement in EVA spread. Just 3 things there. I could bring in return on invested capital. And if we like that, we could actually put that here and then replace EVA spread. If the model allocates 0, we could just bring return on invested capital. The nice thing is once we do that, it just automatically updates everything. So it's pretty easy. And then the last one is risk. On risk, I've got 4 things, but I know the models probably only use one of them. But the Bloomberg default probability is a tremendous one because it has everything in one number. So the lower the number, the better, the higher the number, the worse. So I don't know why I don't have this as a percent. It's a pretty high percent. I brought in net debt to EBITDA. The problem with net debt is you can get some negative numbers. If a firm has more cash than debt, net debt takes debt minus cash. But still, there lower is better, higher is worse. I brought in the 90-day vol. Most of your industries are going to ignore that, but every once in a while, technology companies, the 90-day volatility, it's a real simple formula. It's just the volatility of their stock price over the last 90 days. Real simple. And then the short interest ratio, I brought that in because that can sometimes be an issue for certain industries. You know, remember the short interest ratio? It's how many investors have this stock shorted? You know, obviously with GameStop, that was a huge issue a few years ago. For most industries, it's ignored. Sometimes for tech industries, or sometimes like with GameStop, it becomes an issue in certain industries. But probably the model is going to ignore that, but we've got it in there. So 4 things under risk, it's probably going to put almost everything under default probability. And then for consumer staples, I only brought in 2 statistics. I brought in EV, the EBITDA, and EV, the sales. For your other industries where you might bring in price to book, we might even bring in 3 things. We'll see. But I brought in 2, mainly because I knew price to book would not work. There's too many of these consumer stocks to have negative net worth. I knew I was going to get a lot of NAs, so I didn't even try price to book. So I brought these 2 in. So that's all of my data. And in the Bloomberg spreadsheet, it's formulas that I can't bring in here. But you need something on turnover margin, capital, return on capital, and risk. Those are the 4 categories I like. The next thing I did, once I have this data, and this can take some time, is you're going to get a lot of NAs are going to come in. So we have to spend some time eliminating NAs. I've tried all different ways to get rid of NAs, and it just gets a little tough. So what I actually did was, first of all, I try to find a column that had a lot of NAs. So if your industry, like one column that has almost half the companies are NAs, that's the column we might look to find a substitute. Instead of bringing this in, we'll bring this in. All right, so like with Allison's company, gross margin may be all NAs because real estate companies don't have gross margins. So we'll say, okay, we'll find something else to put there. Because we don't want to eliminate NAs if it eliminates 90% of our companies. All right, once we get the data we want, then we'll probably look in the column that has the most NAs, sort it by that, get rid of those NA companies. And then we'll look for other columns. So that's going to take some time. You have to go column by column. I've tried other approaches. I have not found an approach which is foolproof that it works. So we'll just have to go column by column. There's a lot of columns. So we'll have to do that and get rid of those NAs. Me getting rid of the NAs, it eliminated 30 companies. But we got to get rid of the NAs because the model can't rank NA. I have in the past, like if there's an NA, I'll just give a really bad number. But if it's 30 companies, I give them a negative 500,000. I just think it's a little risky to do that, so I don't do that. It did get rid of Walgreens, unfortunately. And that's the other thing you could do is look through here. It got rid of Beyond Meats, which is kind of sad. So Walgreens is one I might bring back. I can't show you where Walgreens had the NA, but so that may be something we want to do. We could bring in market cap real quick to see which of the big companies we're kicking out, because that could be an issue. But there aren't that many massive companies in here. You probably haven't heard of most of these companies. I don't see any other major ones. Kellogg's, that's kind of sad. But 30 companies, but I kept 92 companies. So I got a good list of companies there. Okay. All right. So what are we going to do with this? So I've got good measures here on these companies. So what we do over here on the side is we're going to rank them. So we're going to rank the first company. I don't know if you have used the rank function before. We'll rank the first company against all the other companies. And in column 0 means higher is better. So do comma 0, the highest number is going to be ranked number 1, the lowest number is going to be ranked last place. All right. So here on 3-year sales growth, HF Foods is the highest. I don't know who they are, but they've got the best turnover. Asset turnover, the same thing. Just rank each one. Now you notice I go from column D to column E to column G. Why don't I have column F? Column F was the asset turnover 3-4 years ago, so I'm not looking at that. What I have done, and this is something you can think about, is it's kind of nice that this part just goes D, E, F, G, H, I. So sometimes what I do, I didn't do it here, but sometimes what I do, if I have a column like this that's not in my ranking, I'll actually cut it and paste it off to the side and get rid of that column so I can just copy everything over. You see how that would be a lot faster, right? So that is an option. So we might talk about doing that. I didn't do it here, but so I could actually move this over to the side, get it out of the way so I don't have to worry about copying this over. So we'll see. I might actually do that next week. ATO expansion, same thing. Working capital management. You can't tell the title, but that's the title. No, it just says working capital management. I don't like that title. Now you might ask, why am I referencing the titles? And the reason I do that is if we find a column we don't like, we can go back to the Bloomberg tool, change that factor, change the data in my title column title is automatically updated. So I don't have to worry about that. So that's why I like to do that. That also helps me know which column to do the rank on. If that's column D, this leaves me column D. All right, then I do gross margin the same way. The growth in EBITDA to sales is the same way. EBITDA margin expansion. So there's all my margins, my WACC and WACC expansion. And then I get the default. What do you notice is different about the Bloomberg default? Jump out. Column 1, not comma 0. Why? Because higher is worse. All right. So here, number 1 means they have the lowest probability. Their probability of default is 0.003%. That's the lowest number out there. And so they're ranked number 1 on default. And the worst is going to have a really high default probability. Same thing on debt, comma 1, volatility, comma 1, and short interest ratio, comma 1. I will say Dr. Mizor, he used to teach here. I think y'all miss Dr. Mizor's my favorite professor, probably the best finance professor in the state of Texas. Is wonderful, but he retired a few years ago. But he doesn't like that we put short interest ratio in here. And he didn't like my answer for why we put it in there. And that's because some industries it's the only thing we can get to work. And he's like, no, because he doesn't like short interest ratio because they're very volatile. They can switch pretty fast. So it's not really a long-term perspective on the firm. So maybe it doesn't belong in there, but I put it in there because some industries we really need it. All right. So we've ranked all these companies. Now we have, this is where it gets confusing. So make sure you're clear on this. Now we're going to do EV to EBITDA. So do we use comma 0 or comma 1? You might say you use comma 1 because higher would be worse, wouldn't it? It'd be a more expensive firm, but we're not going to do that. We're going to do comma 0. The reason for that is if a firm ranks really, really high on all this stuff, you would assume they would also rank high on their valuation. And that's what we're comparing. If they're number 1 on everything over here, they should be the most expensive. So we want a 1 versus a 1. Okay, so that's the reason we use comma 0 and comma 0 here. All right, and so I'm going to go back in here. And I have 15 things I'm ranking. And so I'm gonna put in here 1/15 in each one of these. If I do that, what will they add up to? 100%. Okay, all my weights equal 100%. And then I have 2 of these, so I'll do 50% in each one of those. So I have 100% of the fundamental and risk factors, and then 100% on the valuations. Remember, we use the fundamentals and the risk factors to forecast the relative value factors. Now, if I use equal weight, we start with equal weight, my R squared, my correlation is only 0.07. That's not very good. That's failure. So what we want to do is change these weights to get that correlation as high as possible. So how do we do that? Data, and what's missing over here? So we need solver. Y'all know how to get solver in? File. Where is it? Options. So file, options, add-ins, Excel add-ins, and then click on solver. And if I were you, I would click on these other 2 as well. If you were doing the regression approach, remember we talked about that last time, you would need this tool pack here. All right, so file, options, add-ins, and then add in the solver. I always wondered why that wasn't already there, but I've now discovered once you add solver and these other things, it takes Excel a lot longer to load. So it is kind of a pain to have it in there, but it is nice. All right, so solver. Now you might say, okay, now we got to set up solver. Well, actually, my spreadsheet is already set up because I've already done it. So let's walk through the solver. What do we want to do? Our objective function is to make that correlation as high as possible. Now we really want R squared to be as high as possible. But the reason I'm using correlation and not R squared is we could get a high R squared because our correlation is negative 0.9. We don't want a negative 0.9. So if we maximize correlation, we'll also maximize R squared. So I'm going to maximize that by doing what? By changing these percents. Right? I want to change all of those. Subject to what? The fundamental risk factors need to equal 100%. The relative values need to equal 100%. And I got some other constraints I'll talk about later. And then we just click solver and we let Bill Gates do all the work. There's Bill Gates. Did a pretty good job. And my correlation is 85. What's my R squared? 72 or something, right? Maybe. 73. So is 73 good? It's not horrible, but I'll show you how you can get it better. So correlation of 0.85. But what did the model do to do that? What did you notice on the relative values? What did it do? Just like we expected. Everything went to EV to sales. We knew that was going to happen, but we tested it in. For tech stocks, you would almost think 100% would go to EV to the dog, but we'll see. I've seen some where it's 50-50 or 60-40 or something like that, so it might do both. That's okay. We can live with that because we've somewhat expected it. What we're going to have problem with is over here. Didn't put anything on sales growth. It did put some on asset turnover expansion. Put very, very little on capital management. As we would expect, these are consumer stocks. It puts 69% on margin. We somewhat expected that. That's not that unexpected. Nothing on margin expansion. 10% on WACC EVA, so that's kind of nice. 11% on default probability. But why did it do that? Well, because I told it to. All right. I told it, make sure you have at least 10% in turnover. We eliminate that. 30% in margin, 10% on cap, 10% on risk. For tech stocks, I'll probably put a higher weight on turnover and a lower weight on margin. But if I eliminate that constraint, Let's see what it does to my solution. You can see my correlation went from 0.85 to 0.88. So putting those constraints in there, it lost me some explainability. That's not too bad though. 88 to 85, it doesn't really hurt me. Because if I don't do that, look at my weights. Almost nothing in turnover, almost 80% in margin, nothing in return on cap, 20% on risk. So I want to have some in there. So I'm going to say, why is it 1%? I forgot. I somehow mistyped. So I'm going to say 10%, 30%, 10, and 10. Why not? Why doesn't that add up to 100? Because these are minimums. They don't need to add up to 100. All right. So now when I run solver, it may give me an error message. We'll see. Yeah, I went back to the same 85, so that's good. I don't like how I did this spreadsheet because it's really hard to get around it. Yeah, sorry. I should have set up some tricks to get around it a little faster. So 0.85, that seems pretty decent. Can we get that 0.85 higher? Well, let me show you how we got what we were ranking this on. So here is the weighted fundamentals. All the weighted fundamentals do is take, have y'all used some product before? It's a really, really great function. What some product does is it takes all of these weights and multiplies them by all the rankings for each company. So this firm, their average ranking was 86. This firm, which is the same firm twice, I could eliminate this firm. They're 15th, that's pretty good. Here's 14, that's pretty good. 13 overall. Why isn't anybody, no one's number one? Why is no one number one? Well, the only way you can be number one if you're one all the way across. And no one's going to be number one all the way across. So those are the weights on the valuation, the same thing. But here my valuation is just going to be EV to sales because it's 100% there. So we do the weighted. Now what I do is I'll re-weight the fundamentals. So I re-ranked so that I can figure out where they are. And here I use comma 1. So you can see that the best company right there, their weighted rank is 8, which is really, really good, isn't it? Out of all those factors, it's 8. So that gives them the best overall rank. All right, I don't know who that is. I guess I should have looked while I was there. Here's number 2. Number 1. Altria, yeah. So if you want a tobacco company, so there it is. All right. So we got a model, and the way I've set up this model is I've got some constraints, and there's my weights 100%. So essentially in your paper, you're going to talk about what you measured in your model, and then you don't have to talk about all the individual pieces. You can kind of reference them, but I like this approach better. That just shows how much weight you have in each category, so that someone has some sense of where the weights are really skewing your results. The other thing I did was I looked at the correlations by sector. Now, how did I do that? Well, I took this entire model and I pasted it, but then I took out all the companies except for beverages. And then I reran the model to see what correlation I got. I didn't rerun the solver. The solver, the percents are all exactly the same. I didn't change that at all. But I just wanted to see what would be the correlation if I only have beverages companies. We may not do that on Monday because we might have run out of time, but you can do that. So you can see personal care products and food products did not do very well in distribution. So if I did a model of just beverages sector is the entire sector. Beverages and house products and tobacco, I'd probably get a much better looking model. So that's one way to bring up the correlation, is eliminate maybe your worst sector that just isn't, for some reason, those weights don't work well for this sector. So that's one way we could eliminate. Another way to eliminate, I mean, to get a better correlation, is to eliminate outliers. And you can see I got my correlation up to 0.91. How did I do that? Well, what I did is I added a column on, yeah, this is the wrong title, on the difference between the fundamental weights and the valuation weights. So you can see this firm, we ranked it as 81st, but they're the 57th most expensive. So there's a 24 difference in those two. This firm, we ranked it 28th, but it's the 52nd most expensive. Which company would you rather have, this one or this one? This is what we think. This is what the market thinks. So we think it's a great company, but it's cheap. We think it's a terrible company, but it's expensive. Which would you rather have? You'd rather be at the top. So what I did is I sorted it by the differences, and I got rid of the ones that were really extreme. Because that means there's probably something wrong with this model in doing that. And that can get you. Now, the consumer staples, I probably didn't need to do that because I had a pretty decent model, but for some industries, your first correlation is like 0.4. Getting rid of outliers is about the only way to get us back to a decent number. So we'll probably do that. It's pretty easy to do. You just get the whole thing lined up, and then you just sort it by the difference column in 0.91. All right. So you see where we're going. We got all the values in there. We'll see if we have time to do something like this. For some industries, like the industrials, especially some of y'all are in industrials, there's so many subsectors in the industrials that are really, really quite different that we probably will want to try to do some of this analysis. It took me to build this. It probably took me less than 5 minutes, because once you have it, you just copy and paste the whole thing down, or copy the whole thing over and just sort it by industry, and just get rid of the companies that aren't in that industry. And it's really fast to do. And I think it's pretty eye-opening which ones work and which ones don't. Questions up to this point? Did I go too fast? You can kind of see the layout, the data we bring in for turnover, margins, return on capital, and risk and valuation. Then after that, you just rank them. That's pretty easy. Then you get the weighted rank using that sum product, which is a wonderful formula. They used not to have sum product, so I had to go this one times this one, plus this one times this one, plus this one, and it's a massive formula with sum product. It makes it a lot faster. So we do the weighted rank on the fundamentals, the weighted rank on the valuation, and then I get the difference to see which stocks are expensive and cheap. So on Monday, you want to make sure you have your Bloomberg account. So how did I get these stocks? I used the Russell 3000 index, and then I just brought in my sector. And once you bring in your sector, then it's a decision of what sub-industries you want to bring out. Now, I have with consumers done both consumer staples and discretionary together. That can get a little tricky where it can really mess up your model, but it gives you a lot more companies. So you have to just decide what to do. In some firms like Dolby, I don't even know where Dolby is. If it's under tech or if it's in industrials, do you know? It's under tech. Yeah, so that's gonna be a little tricky. We'll see. Tech is the worst, because we're looking at history and it just doesn't give us good numbers, but we'll see. We'll try to find some way to bring that in. Right. Then once you do that, you get a graph. And so what we're going to graph is our fundamentals versus the market. If it were a perfect model, or then this is what the graph would look like. It looked like that. That's the correlation. That's the correlation of 1. The number 1 company is the most expensive. The number 82 second company is the least expensive, the cheapest. What's the chance you're going to get a graph that looks like that? If I saw a graph like this once, like one student's like, wow, look, we got a 0.98. Well, one of their fundamental factors was had to do with the stock price. So they're using the stock price to forecast the stock price. When you do that, you get a really high correlation. He was so disappointed. He's like, he thought he found the perfect model. So you can't have anything in those fundamentals that has the stock price in it. Because obviously that's what we're trying to forecast. So you can't use A to forecast A. All right, so that would be perfect. So we didn't quite get that. We have a correlation of 0.91, but our chart still looks pretty decent. All right. So I wish I could do this so it's a little easier to read. So here's my ranking on valuation. So the firms down here are expensive. The firms up here are cheap. All right. And down here, this down here is our fundamentals. So the firms over here are great. The firms over here are horrible. All right. I should have edited this a little bit better. And then what I do is I don't do the trend line because that's not what we're interested in. I actually draw my own line on here from axis to axis. Because if the model had a 1.0, every dot would be on this line. The number 1 company be number 1, number 5 be number 5, 20 be number 20. So we rank at 20th, the market ranks at 20th, that would be everything on the line. And so down here are my fundamentals. Here's valuation. So the best place to be would be right here. You rank it number 1 and it's the cheapest stock. How many of those stocks do you have? Well, I eliminated because I got rid of the outliers, so they're not going to be there anyway. The worst place would be right here. You think it's the worst stock and it's the most expensive. So you don't see those. So you want to be up here. These are the good companies. And you want to avoid down here. Or you want to be above the line, and the further away from the line, the better the stock is. So this stock right here is probably the best one. We ranked it 28th, and it's the 52nd most expensive. And I think that's Coca-Cola. So it loves Coca-Cola. Down here, you have a stock here. We rank it 81st. It's the 57th most expensive. So the further away you are from the line, the more mispriced it is. And you want to be up here versus down here, right? Everybody see how that works? Your goal is to get this graph built. Now, we use this in the investment society to do a buy list. And essentially what we're looking for is firms kind of in this region. This firm, yeah, it looks good, but it's 54th ranked. It's not a great company, but it's cheap. So what we have a preference for are firms that are maybe in the top 50 that are far from this line. So these stocks right in here. This one kind of barely misses it, but we're looking for these stocks down in here. This stock, not too exciting. We rank it 13th. It's the 13th most expensive. So not much there. So, and the way we actually do it in investment society, we were looking for stocks that maybe in the top 50, and the difference between our rank and the market's rank is like 5 or something like that. That gives us our buy list. Our hold list might be top 50 and 0 difference, and sell list might be whatever. So we bring them in along those criteria. So your ultimate goal in paper 7 is to do this, but you're not doing a buy, hold, sell list. You're ranking a company. So you can see I've got Costco right here. So Costco, according to this model, which is I agree with it, is expensive. Now, what I don't agree with this is it doesn't rank Costco very well. It ranks at 66. That's probably because this model is so focused on margin. And we know Costco has terrible margins. The model didn't like turnover. That's where Costco ranks well. So I kind of understand why our model doesn't like it. But it is an expensive stock. So it doesn't like it. Walmart is kind of well valued, 60 versus 58. So it's kind of close to the line, not expensive. So that's essentially what you're doing is that where did it rank your model as far as fundamentals? Where to put it on valuation? Is it above the line or below the line? Okay. Now, how did it get Costco in here? Because it's a pain. Some of y'all may know how to do this better than I do. But the way I do it, and we'll do this next week. Costco 66 versus 51. How do you find that dot and all of that? I just go in and add 500. Anybody find Costco? And then I go in, change the color, give it a title, and then go back and just get rid of that. So if we were looking for, I don't know if Target's in here. Yeah, they are. So if we're looking for Target, just go in, add 500. Click on it. Make sure you only click on that one, right? Bill Gates is real bad about clicking on everything. And just like that, we got Target. Does anyone know a better way to do that? And it's kind of irritating me that I need to note one of these stocks. I mean, I could put the label on every stock, but that's gonna be really busy looking. It's gonna be just too much noise. But there is Target, there's Walmart, there's Costco. So if y'all know a better way to do it, but that's pretty quick, right? It doesn't take you that much time to find the company and put it into the chart. Something else I probably should have put here. Let me get consistent here.
You'd be able to just, add data levels, just check all of them, just go check it once in a while.
But how? But
Probably
I mean, let's say you're looking for.
just on the chart itself, but on the actual points, then format basically. Maybe like actually the chart itself, yeah. They're trying to format that and add labels.
Well, I only want labels on 3 of them.
Right, but you could unclick, I guess, all the labels and just check the ones that you want.
Yeah, you should be able to just pick the one that you want.
But how do you get that list to come up?
Probably.
Because this chart only has the numbers. It doesn't have the companies. So it doesn't know that that line is associated with Target. There's probably a way I could do that. I'm not real sure. There's probably a way to put a data link, but I'm not sure. Well, if you have a better way to do a better way. You don't have to use my approach. That's just the approach I do. All right. So the other thing you might want to add here. Bill Gates. It's such an irritation. Because it does get confusing. Oh, come on, Bill Gates, you can do it. I know you can do it. Is it to know that the stocks up here are cheap? Oops, I want green for good. And the stocks on here are rich. Boy, Bill Gates, you're really bad at this. Oh. Still close. So up above, oh, I can't spell rich. These are the cheap because it's not always obvious. It just depends on which column you put first. I put fundamentals first and then valuation. So above the line is cheap, below the line is rich. So you probably want to highlight your company. If I'm doing Costco, I might actually change this to a different color so it stands out, and then key competitors as well. And then you'll discuss that. So if you think about paper 7, the bulk of it is discussing your model. What did you put in your model? What were you measuring? I've given you here a good summary chart that you can put into your model. You could talk the individual industries as well to say how well the model did. You know, if I'm doing Costco, and I don't know where they go here, maybe distributors. If that's not a strong part of the model, that kind of gives me a little bit concerned that the model doesn't do well, which is really possible because of the overemphasis on margin. So that may make me rethink how to put that in there. So you're going to describe the kind of things you're measuring, the weight that your model gave to those different ones, and then a chart that includes your company and a few major competitors, and then a discussion that is this rich or cheap. And then what you got to do is get this into evaluation. So we'll talk about how you can do that. Any other questions on that? So you'll see some of these charts in the example papers, especially the more recent ones, where they built this type of model. I think last semester I built almost all the models for them, so they made me do them all because not everybody had a Bloomberg. So we're gonna use class time to do that, just so y'all get the experience. This is not a bad skill to know in a first job, because if you did this, they would be somewhat impressed that you could do them. I mean, it's simple, but it's an easy way to get a lot of data in and really assess your firms. Okay. So then I did each one of these. Sometimes there's only a few companies, so you can get some pretty bogus data if you only have 3 or 4 companies, but it did run it. But if you look at this one, I mean, it was 2, 1, 4, 4, 3, 3, 5, 5, 1, 2. I mean, it was practically perfect all the way down. We saw that when we did airlines. They were all just perfectly lined up. So this model seems to do a really good job of assessing tobacco companies. The other thing you can do that's really, really, I think, important. Let's say I'm doing Costco. And I want to know why. Let me put some titles in here. So I want to know why Costco ranked where it did. So Costco ranks overall 66th. So I can go in here and see the ones that have zeros, it doesn't matter. But on asset turnover, they rank really, really well, 22nd. That makes sense. They don't rank well on capital management. Can't say why that's the case. They rank really badly on gross margin. They rank really badly on EBITDA margin. Those are the 2 weights that explains why they rank so low. On EVA spread, they rank really, really well, but that's only 10% of the model. On default, they rank really, really well, but it's only 11%. So you can, I mean, as we already knew that, Costco ranks low because this model emphasizes margins, and we know they have really, really thin margins. All right, so what if you don't like the output of this model? So here's something you can consider doing. What I like to do is take this line and copy it up 1. Actually, I'm gonna copy it up. Well. And so I'm gonna say is, you know what? I need something on sales growth. I gotta have something in there on sales growth. I'm gonna do 5% on that. I don't need turnover because turnover expansion came in. But you know, capital management's really, really important to me. Gross margin's fine, but that's a little much on net margin. I'm gonna take out 19% on that. EVA spread, I'm glad it put something in there on that. On risk, I want a little bit more on risk. So I'm gonna put 9% in there. Let me add these up. These add up to 0. It says 2, so let me take out some. Should get me the 0. All right, so what I'm gonna do is, this is the original what solver gave me. I'm gonna adjust that by taking that and adding this in. And when I do that, it still adds up to 100%. Right? And what happens to my correlation? Still looks pretty good, right? Didn't really hurt it that much. I like this model better. So then when I go back to my values, oh, well, I didn't change it. I didn't change it there. So then when I go back to my values, I'm using these new numbers. And when I look at my chart, it did change it. That doesn't look like an R squared of 88 anymore. So I'm wondering if I've got an R squared problem here. Yeah, it looks like it's doing well. Is it worse than my R squared here? Oh, that it was 91 before. I forgot. Right, I'm thinking 88. So I got really outliers. I went from what 85 to 91, and then I changed the factors and went from 91 to 88. So it didn't hurt me that much. And now there's my chart. So what happened to Costco doing that? As I put more weight on turnover, it took it above the line and now looks a little cheap. All right, so how could I discuss that? I could say I ran the model to give me the highest correlation with the market thinks, but the market had a overemphasis on net margin, which we know Costco is not a strong contender. So I adjusted the market's weights, what gave me the best mix of the market, to what I believe is important by adjusting these factors. It gives you a little bit more to discuss. And you can say in doing that, it brought my correlation to the market down from 0.91 to 0.888. So it's still an effective model, but I think it better reflects what we think is important for evaluation, something like that. It just gives you more to discuss. Your chart looks different. It's important because it took Costco from expensive to cheap, took Walmart to even cheaper. So it gives you some influence. So you don't want to just say, I ran R squared, I ran the solver to get the highest correlation in the market, and that's my model, because then you're saying the market's right. And that's one of the reasons for being an active analyst, is you don't believe the market's right. So you want to put your own weights in there. All right, everybody see what I did there? We didn't lose anything. At any time, I can go back and change all of these to 0, and I'm back to where I started. But at least here I have some influence. As long as the sum of them add up to 0, we're fine. We don't run solver again, because obviously we go back to the original thing that we started with. So that's another approach that you can take. That's pretty powerful. So essentially your paper 7 is explain all of this. Okay. Explain what you did, which is actually pretty simple to do. You'll see some papers that do that. Since we're talking Costco, why don't we do Costco? Load it again. I think he did something similar to that. And again, the team that did the CFA research challenge, they did this in their research challenge with some pretty good success. So you see that, right? That looks good. He's got expensive up here and cheap down here. Why? Because he flipped. He has the valuation first, then the fundamentals. So he did them backwards. I think he likes that because you want to show he should have used the word rich, but it's nice to have expensive high and cheap low. So I think he switched it because it just looks a little more natural. So here's how he showed his weights. That's a pretty effective way to do it. So he talks about his weights from each sector. I don't know if he talked on. Oh, we got to talk about this. That's the one other thing. We'll have to do that after next week. I need to update that model. Yeah, so, and he did a pretty good job of marking them. He made it look a lot more professional. Well, it looks almost exactly what we started off with, doesn't it? Except for Walmart has moved to cheap. He did this before he changed his weights. He's got BJ's and Kroger in there as well, so he picked some other as well. So, all right, any questions up to that point? So now the question is, how do we figure out if Costco is cheap or rich and how much? So let's find Costco again. So a simple way to do this would be simply to say, so here, why do they look, let's see, yeah, 47 versus 50 first. All right, so how much would their valuation have to go up so that they're 47 and 47? So it's just a manipulation of that number to figure out what would they have to do. So you're essentially going to say right now their EV, the sales, where is it? Is 0.97. What would that need to be so that they're at 47? So I already got it. So here you can do data, what if analysis, goal seek, make that equal 0 by changing that. So there it is. Oops. So let me do it again so you can see what I did. Make that different 0 by changing this, make that equal to 0 by changing that. So that gives you EV to sales of 116. So they were whatever they were before. I can't remember. 96 to 116. How do you adjust the valuation? Well, you take the current stock price and multiply by 1.16 divided by 0.91, and that tells you what the current price is. Okay, so it's pretty simple. What could they be trading on that this model has them well valued? All right, very, very, very simple approach. Right. Save it. I guess I could put this out there on Canvas. I'm not sure what you would do with it. Y'all want me to put it on Canvas? I mean, you always say yes, but I don't know what you would do with it, right? So maybe it is backup if you have a formula issue. Now, one thing we got to make sure we do on next week is when we get this data in on Bloomberg, we gotta copy and paste it as values. But we gotta be careful how we copy and paste it value. You can't just take the whole thing and paste it as values. Because we need those formulas off to the right. So we have to be real careful. I had to be real tricky, real careful. That I only copied and pasted. So you can see there's formulas in here because that wasn't a Bloomberg. So I had to be real careful which columns have the Bloomberg formulas. So those are the only ones we want to copy and paste so that we don't lose that. So we actually want to build it in Bloomberg and run the model in Bloomberg just in case we need to change some of the data. So we can't copy and paste it first. We got to get rid of the NAs. We got to get the right data in. Make sure we have a decent model. So you can see here my correlation doesn't work, but we'll actually get the correlation with the Bloomberg data. Once we have that, that's when we'll copy and paste it. Because if we copy and paste it, we don't have a good model. We got to go back to Bloomberg and pull in data, right? So it's a several step. So you can see why I gave us Tuesday and Thursday and not just one day, because this is probably going to take the entire class. I think I should have timed myself. I think it probably took me 30 minutes to build this. But it's probably going to take some of y'all longer than that if you've not used Bloomberg before. It's going to be, just giving you some of these formulas. In fact, I think I will put this on Canvas. Actually, that's not about it. I'll put this on Canvas so that you have this formula at your fingertips. That probably will save us some time. So that would probably be good. So I will put this out on Canvas. Pretty powerful, right? If you try to build this at home with Capital IQ, there's a few of the things that are not available in Capital IQ. I don't think Capital IQ has economic value added, so that one probably wouldn't be there. I don't think it has 3-year sales growth, but 3-year sales growth, if you don't have 3-year sales growth, you just get revenue today and revenue 4 years ago, and you calculate it yourself. So you can still get it from them. And then we'll figure out on your companies. We might actually start with this model and adjust it, but on these in your companies, which of these factors we're going to bring in, because it will vary by company. All right. There is one file I needed to show y'all just real quickly. I forgot all about this, but we need to add it, but it's real simple. So I need to update this model to show it to y'all. So we'll do this after next week, but I'll just show it to you. This model is already built, so we might actually do this. Now I'm glad I thought about this. If we have time, we'll do this next week as well, because it just takes a few seconds to bring the data in. We can copy and paste it, and then you'll at least have the file and we can talk about it. So all it does is it brings in the PE ratio, EV, the EBITDA or the sales, price to book, and EV to EBITDA for Walmart back to 1990. It then does that same thing for the consumer discretionary industry, and it does the same thing for the S&P 500. So that we can see where Walmart is. So we want to know, is Walmart trading not just rich or cheap, but are they trading rich or cheap to the market and to their history? So we're going to say things like, Walmart is currently 10% rich to consumer staples. Historically, they've been 6% to consumer staples. So right now, they're a little rich to their history. On EV to sales, you can see how easy this is. Right now, they're trading at 43. So they're really cheap to sales, which you expect with Walmart. They're trading cheap, but they're trading even cheaper than they have historically. Right now, they're trading at 0.43. Historically, they traded at 0.52. This is a really easy one because it's set up. So I'll try to remember to have this file so we can do this as well next week. It usually takes a few minutes to get up and loaded. All right, so we got those two things. This one's kind of a gimme, you'll see in there. And this is really quite powerful, that relative value, richness and cheapness. If you're talking about a stock, you want to say, yeah, they're trading 20% cheap to the market, but they usually try trade 30% cheap to the market, so they're a little expensive versus the history. It just sounds intelligent, sounds like you know what you're talking about, so it's a good tactic to have. So I will save this. There's actually not much updating I need to do on this. So I'll save this and I will put it. I used to have graphs built using this massive formula that just kept blowing up on me. So you'll have to build your own graphs, but that's pretty easy to do. So I'll put both these files out there under files for paper, both for paper 7. And so this gets us to about 90% of paper 7. All right, any questions on anything? See where we're going?